Hello and welcome to London Property. I'm your host Farnaz Fazaipo, and today we're delighted to welcome to the show Matt Bird. Thank you for joining us.
Thank you.
Matt is a partner at Sayers Butterworth, who are tax advisors. And I always like to get tax advice from people who actually specialize in numbers, because I think that, tax law is important, but actually really to understand the details of what you need to do, it's really important to speak to people who deal with numbers. So welcome to the show. So before we go into the details of the conversation, I'm going to ask Matt to tell us a little bit about how your experiences brought you to us here today.
Yeah, of course.
So over to you, Matt.
Well, thank you for inviting me, first of all. My name is Matt Bird. I'm a tax partner at Sayers Butterworth. We're a firm of chartered accountants, tax and business advisors over just off Fleet Street in central London. And we're a fairly small firm, but as a result of that, hopefully we can sort of tailor advice to clients and be proactive. And as for myself, scarily, I've now got sort of more than 25 years experience in the sort of UK tax side, and a majority of that has been spent advising non-doms on UK and sort of offshore tax issues that may arise.
So you really do specialise in our target audience, which is basically people who have prime property interests. And sometimes that's in London as well as in other places. So you've got experience in other jurisdictions like the Jersey, Guernsey trusts and Liechtenstein, my favourite subject.
Yes, Anstalts and Stiftungen and all of those.
Yeah, exactly.
But sort of slightly strange, sort of unknown quantities as far as sort of UK tax law is concerned.
Yeah.
Absolutely.
So this is going to be history. So just a little bit of history about what's soon to have been the non-dom status. How did it come about to begin with? The UK's had some form of non-domiciled tax status for more than a century. And in very simple terms, it is a way where non-domiciled but UK resident individuals only pay tax on their foreign income and capital gains if they bring that money or enjoy the use of that money in the UK. The rules regarding whether money has been remitted can be fairly complicated and throw up some traps, but in very simple terms, if done properly, a non-domiciled UK resident would only pay UK tax on their UK income and capital gains. Right. And this was historically done for reasons of the empire and in India and what have you?
Yes.
Okay.
English businessmen trading in India in various points of the empire.
Exactly. Well, in the good old days when we first came to this country, you only had to say, I'd rather be buried back home, and you were non-dom.
Yes.
So those days are gone.
Yes.
And now we're going into a future where people who were here under that regime need to consider what they're going to do next.
Yes. Yep. So the non-dom regime has been tightened up over a number of years, starting with probably going back to sort of changes to offshore trusts, 1991, 1998. But the first big change was 2008, when longer term residents who had non-domiciled status had to start paying a remittance basis charge of £30,000, and that then progressed depending on all the way up to £90,000 if you had been UK resident for sort of 17 years or so. Then there were some further changes, but under the Jeremy Hunt's last budget last year, he announced he was abolishing it. And then that was followed through, because it was before that point Labour policy to abolish it as part of their sort of soft manifesto. And Rachel Reeves has followed through. So as of 6th of April, non-domiciled status is no more.
Is no more. And obviously there's been a lot of reaction to this, and potentially people who were planning to leave probably brought those plans forward. But
yes. Yeah.
Is that just being really positive about it, or is it?
No, I think it has made a huge impact. I think part of the issue is the changes to
inheritance tax, because I think to a degree people may have accepted having to pay tax on their worldwide income, but the changes to the inheritance tax rules that it applies to worldwide assets after 10 years, or well, probably technically 9 years and 1 day of UK tax residence, and 40% inheritance tax on worldwide assets, that is something that people are keen to avoid if at all possible. So I think people have been leaving the UK, unfortunately.
So somebody at your level of expertise probably
Yes.
gets a bit more insight into what the government is doing and consulting than we do, and what we read in the press. But do you think that there is any chance that there might be a bit more light at the end of the tunnel? Or if it was you, what would you say would be a good compromise?
I mean, firstly, I think there may be some very small changes that may help a small number of taxpayers in sort of particular circumstances. But I think the abolition of the non-dom status, the 4-year sort of exemption for foreign income and gains for new residents, that will remain. There may be some changes depending on whether someone is resident or not resident here, but I think they will come into force. Yes, I don't see any major changes.
So let's go backwards then. So let's talk about from the 1st of April, what does it look like for people?
So if you're already resident here, from the 6th of April, they will be paying tax or subject to UK tax on their worldwide income and worldwide capital gains. That will also extend to income and arising within trusts that they have settled and are a beneficiary of. So it's quite an extensive change, not least because the changes first started in 2008, and there have been various changes over the last sort of 17 years for non-doms, not just directly on their personal tax affairs, but also on their sort of the structures that they are likely to have been advised to set up, either whilst they're here or before they came here, one of which were the concept of a protected trust, which avoided having to pay income tax on a trust that was considered to be untainted, that had been in existence for sort of predating the changes back in the late sort of 2010s. Those protections are being removed from April. So that will be a big change, not just on an individual's own income and gains, but potentially income and gains within a family trust or another type of trust and so forth. So there are sort of big changes for individuals.
Okay, so you are in the UK and you decided you want to stay in the UK.
Yes.
So what's the best thing you can do under the new regime?
Well, a lot of planning is involving making use of the TRF. It's a facility to allow you to remit untaxed income and gains from earlier years and pay a flat rate of 12% tax. So a lot of the advice for people who are able to do so would be to accelerate income and capital gains before the 6th of April this year, claim the remittance basis, and then bring it in next year and pay 12%. And that, although there's a tax liability, it's far less than 40 or 45%. And it also sort of then enables them to potentially defer a decision because they have a spending pot to cover their expenditure over the next 4 or 5 years, say. And then sadly, I think a lot of people are taking the view that at that point, they may then sort of leave, because after 4 or 5 years of paying tax on worldwide income, they maybe at a point where London isn't quite so attractive. Not that London isn't attractive, but the tax rules.
The tax rules. But is that putting us really in line with the rest of the world? Where do we sit with the rest of the world? I mean, okay, so you leave London and you go, okay, you know, there's a handful of places you can go to where, you know, maybe you don't really want to live there and you'll probably spend as much money as you save in taxes getting out of those countries. But,
I think, I mean, the last big changes were 2008, which brought in sort of the remittance basis charge and effectively losing the ability to claim sort of non-dom status after 17 years and so, and that's sort of since changed to 15 years. But 2008, there weren't many options available. You know, there was Switzerland and Monaco typically, and Switzerland is a beautiful country, but, and there's no offence meant, but it isn't London. And the same, Monaco is quite small and can be horrendously expensive if you want to rent a 3-4 bedroom apartment. So there weren't really that many options available. Whereas now, you know, despite some countries changing their rules, making it more difficult or increasing the cost, Italy, Portugal, Greece, they all have sort of friendly tax regimes for new arrivals. And also further afield, Dubai has changed hugely over the last 15, 20 years. And that is now a prime destination for people leaving the UK to move to. Even countries like Singapore are attractive because, you know, it's a long way, but the focus of the world is moving. So I think whereas maybe policymakers have fooled themselves into thinking that people didn't move so much as were feared in 2008, but 2025, there are more options. And I think we're already seeing that, you know, both from directly with clients and also with anecdotally talking to other advisors, that people are already taking steps to either leave or have already left.
I mean, as they say, death and taxes are the two certainties of life. But, you know, there's some pills you can swallow and some pills you can't. So I guess that if you're not a UK originally an English person, then, you know, you've got all this wealth somewhere else, and then you decide that you want to move here, you sort of want to have the ability to circle the wealth that you have somewhere else if you're not bringing it here. So does this mean that if you are currently a non-dom and you decide to bring your money in before the 6th of April, you pay nothing?
Well, if you're already UK resident, you should really wait until the 6th of April to take advantage of the 12%.
Right, so it's taxable before the 6th of April?
Normal 20, 40, 45%.
Okay, so then you can bring it for a period of 4 years? No.
Well, ideally within the first 2 years to take advantage of the 12%.
12% is 2 years. So you can repatriate, is that the right word?
Yes.
For 2 years from the 6th of April at 12%. And then what happens to the money that you're making somewhere else if you don't bring it? That still gets taxed at full rate?
Yes, any income arising from the 6th of April. And this assumes that these individuals have already been resident for 4 years in the UK.
So historically, they've been resident already for 4 years. Then any money they're making anywhere else is subject to income tax here or to whatever tax it's here. Yes. Unless there's a treaty with the country that they're coming from, then they paid it there. They don't have to pay it here, or they have to pay the difference here.
Typically, in most cases, double tax agreements will give the taxing rights to the country of residence.
So if that was less, you're going to pay a bit more here to top it up?
Yes.
Okay.
Yeah.
So that also is going to get you. And the people who come for the 4 years go back to the old non-dom regime for just that 4 years?
Yeah, so new arrivals, they have a 4-year period where they are not taxed on their overseas, their foreign income and gains, FIG, is the legislation refers to it. And they're free to bring it in to the UK. So for new arrivals for 4 years, the new regime is more generous than the old regime, which paradoxically sort of discouraged people from bringing money into the UK. So we would have to, there was always a period where you wanted new arrivals to do planning before they became UK resident to maximise the sort of the capital that they had before they came to the UK. Because, for example, an asset standing at a large capital gain sold the day before someone became UK resident, you didn't pay UK tax on it. Sold the day after they became UK resident, that was taxed, and the entire capital gain was taxed. So there was there was a large gain that had nothing to do with UK residents that was still subject to tax. So, like with a lot of tax planning, it came down to advising the client before it was too late. You know, like lots of things with tax planning, you know, once something has happened, you can end up just fighting fires in struggling to actually get the best result.
Right. And the other thing is that I went actually, the Treasury had a listening clinic, and it was very much a listening clinic. You couldn't ask any questions. They kept saying, we're only listening. And I was probably, you know, the only non-tax expert who was there. So I was listening to all the people giving their comments. And one of the things that somebody said, which was really interesting, is, so we're going to end up being a place where people come for 4 years, sell their really expensive businesses, and then leave. So maybe that's a silver lining, because that means that you get a lot of people who are going to gain from, you know, somebody coming here and selling their $1 billion company.
Yes.
But then at the same time, you know, we just heard in the news that somebody decided to go and float in New York rather than London, you know, for billions of dollars because of everything that's happening here.
I mean, on the cynical side, it encourages people to come for 4 years. So that could be 3-year university or, you know, a few years for a PhD or something. It could be 4 years just to experience London. And it also possibly, you know, given it encourages people potentially to spend less time in London. So if someone is fortunate enough and wealthy enough to have properties in various different countries, from a UK perspective, to avoid these rules, it may just be that they reduce the time spent in London or the UK to become non-UK resident.
And that's the 90 days.
Well, it's slightly more nuanced, but yes, someone leaving the UK, depending on circumstances, could get away with spending 90 days or less in the UK and not be UK resident.
Yes, and you can't get up in your private jet and come down again because now it have to be 12 nautical miles away.
Well, yeah.
So that doesn't work anymore either. It's interesting.
Yes, so there may be people sort of gaming the system, if you want to call it that, but it's, to a degree, it's about where do you want, I suppose, in putting politics aside, you know, people spending money, anyone spending money in Britain is paying VAT. And there's already, you know, now that tourists cannot reclaim VAT back on their shopping that they've, you know, money they've spent in Harrods or Bond Street or wherever. You know, I've heard stories of tourists who come in and they will go to Paris on the Eurostar, where they can reclaim the VAT, and the VAT they save pays for the Eurostar, maybe a night in a nice hotel and some nice meals. And that's money that would have been spent in London.
I hope there's a bigger plan we're not understanding, because at the moment it all looks really, really negative. The other thing that I'm wondering, I mean, so when Rachel Reeves came back from Davos and said, you know, we're going to loosen things up for non-doms. I almost feel like she went to Davos and nobody talked to her and she came back, she thought, God, I've got to do something. But what does that mean then? What could they potentially do that is just going to add a little bit of something sweet to this situation?
I think we're probably too long down the road for there to be any meaningful changes.
People have already made their decisions and made their plans.
Yes, and there may be some small sort of technical changes in some sort of refining to help people in specific circumstances, but the idea that the 4-year, unless I've completely misread the situation, the idea that the 4-year sort of exemption period could become 6 years or 8 years, or could be extended by payment of a sort of a forfeit, similar to Italy or Switzerland. I think that's
all they can do. But then they're still hitting everybody with the inheritance tax, so they're going to go anyway. But I think one of the things actually that came out of that listening cling was also that if people are bringing their kids here for senior school, then at least they need to be here for 5 years. But ideally, a lot of people are actually bringing their kids earlier. Yes. So to try and align it with that, especially since most of us are not going to be able to pay the extra 20%, you need those people with money to come and pay the school fees. So it's all mishmash.
Although this is not to do with the changes, but it's more to do with the UK residence rules, that probably then encourages boarding school, because you can avoid a connecting factor for the statutory residence test. If your children, although they are in the UK, they minimise their time outside of term time. So if effectively your children can be in the UK during term time, but their school holidays, they're spent, skiing in Switzerland, holidaying in...
Yeah, but you're still separating, families by doing that. I wouldn't want to put my children in boarding school in another country and not be a phone call away. So
yes.
Now, obviously, London is London, and a lot of people want to be here, and not everybody changes their life because they have to pay tax. Yeah. So, what would be wise for people who are considering moving to the UK to do before they come? And when they get here, because obviously every circumstance is different, people's individual situations are different. So what would you say?
It's never too early to take some advice, because, as you say, everyone's situation is different and everyone's approach to tax is different. And you do have to weigh up the complexities of some planning with just the simplicity of being able to live your life. And people do approach those differently. So it's always ideal to take advice before you become UK resident, because that gives you a period when you can take steps to actually sort of be tax efficient from a UK perspective. That doesn't necessarily mean doing a sort of a complicated, convoluted structure. It can just mean sort of identifying, realising assets and having sort of a pot of capital that you can spend. There's also sort of ensuring that you're in a position to maximise the sort of the 4-year exemption. But yes, everyone's situation is different. And also, I think for people who may have been UK resident in the past or have been advised with a structure, since the rules started to change in 2008, I think most advisors in this field have seen people who relied on original advice, whether that was in the 1980s or 1990s, that a structure was tax efficient and compliant. And rules change and things get brought into the tax net, additional compliance procedures. And so it's just never assume that just because something was compliant and efficient 20 years ago, that it still is. And so if you do come to the UK and you think everything is protected or efficient, that may not necessarily be the case. So yeah, I mean, I think that's the main one. Just don't assume that what worked for a friend will work for you, or what was right for a friend was right for you. So yes, just take sort of proper, sort of qualified professional advice.
And trust your children and prepare for succession planning earlier so that you don't expose yourself to inheritance tax. The other question I wanted to ask you before thanking you and saying goodbye for this particular conversation we're having is the thing that actually concerns me more is the entrepreneurs that are here generating business and, don't want to be counting, oh my God, I've only got 90 days, I've got to rush out now, when they're trying to do a massive transaction that's going to have so much benefit to so many people. So is there any light at the end of the tunnel that they might actually have slightly different rules for entrepreneurs that are actually employing hundreds of people?
Not that I'm aware of. I mean, it may be, but that's above my pay grade.
Yeah.
I mean, I think there was a general feeling that the 4-year exemption for foreign income and gains for new arrivals, that works perfectly for people who can plan the next 4 years, whether they're in the UK for schooling or whether they're in the UK for another reason, whether it's a secondment or whatever it may be. It's possibly not so ideal if you're an entrepreneur and you're in Britain setting up a business whilst also running companies or businesses in a group in other jurisdictions, because you may end up in a position of being resident in year 1, but then having to reduce your time in the UK because you've got to go back to Dubai, for example, to run the business there because there's a transaction, and then come back to the UK because the 4-year exemption period is the first 4 years.
Right, it's not like you've done 4 years, you've done the 2 months now and then 2 months later, and you're not adding them up.
So it's not 4 years in the first 10 years, it's the first 4 years. So if you come, once you've been resident in the UK for 1 year, you're counting year 2, year 3, year 4. Even if you do year 1 UK resident, year 2 resident in France, for example, running a business, come back to the UK, leave the UK, come back in year 5, you're no longer in that 4-year exemption period. So it, in a way, it penalises entrepreneurs who can't plan necessarily sort of 3-4 years in advance.
Yeah.
So all countries have some form of residency rules in their domestic legislation. This is where double tax agreements come in, because there is a tiebreaker for residents where an individual is resident in 2 or more countries. The UK thinks you're resident here, and say France considers that you're resident in France, and the double tax agreements will have a tiebreaker which looks at where you have sort of available accommodation. Do you have a home in both countries or only one country? Do you, and then there's a tiebreaker which looks at your centre of vital interests, your economic affairs and social affairs and so forth. And that tiebreaker is designed to ensure that you are only ever resident or treaty resident in one country. So there are ways where you can be resident in the UK but not treated as a resident. But
there you go. There's the tax planning that comes in before you come.
That isn't to be taken lightly, because you have to look at the double tax agreement, weigh up sort of the factors where your centre of vital interests are, where do you have homes, and it's very much on a sort of case-by-case basis. Yeah. So it's not something to rely on, because effectively tax authorities, if they think you're trying to game a double tax agreement, that's where things fall down. It's meant for sort of genuine situations where someone is splitting their time between two countries.
Yeah, and I think there's a lot of people who have that genuine need. So there is some hope of trying to keep the entrepreneurs and keep the economy excited and people wanting to be here and wanting to do business here.
Yeah, but like with anything, probably more than if you're going to intending to rely on a double tax agreement, that definitely needs expert advice, because it's not something to sort of just...
So I was looking for a light, and I think that might be one of those lights. So just really before saying goodbye to you now, if all the countries and tax treaties in the world are 100, right, where do we sit compared to other countries in attractiveness? Are we, in line with most other Western world?
For double tax agreements or?
No, just for the way that, a resident of a country is being treated. I mean, I know that, some Scandinavian countries have 40% tax, and then you pay 40% if you want to take the money out. So there's some places that it's even worse. But where do we sit in the rest of the world? Are we just are we now going from being super attractive to just being normal now?
Yes, I mean, to a degree, if you take out sort of the special regimes in Italy, Greece, Portugal, and you just look at sort of Germany or so forth, but yes, I suppose so. But as the world has become smaller, we obviously can't compete with Dubai. So, yes, I mean, it is a big change for non-doms, and I think that's the main thing. For the normal person, it's not such a normal, whatever that may be, it's not such a big change. But if you're coming with sort of a global exposure to sort of assets in multiple jurisdictions and so forth, and a lot of those interests are never going to have any connection to the UK other than the fact you're living here, then yeah, the changes will make a big change.
Well, I hope that somebody important's listening to this and they introduce a £500,000 a year flat tax, and then they might see a reversal of the 10,000 millionaires that they say have left already.
Yes, so I've read in the press, yes.
Thank you very much. That was very informative, and hopefully we'll have you back with the new non-dom changes that might come, in the months to come. So we are at London Property focused on helping people manage their property wealth. And if you have any questions with regards to how to set yourself up with making more investments in the UK or your existing investments, tax planning for the next generation, then please do get in touch, and I'm sure Matt would be delighted to help you. Thank you so much for coming.
No, thank you for having me.
Thank you.